always do, we're going to kick it off with a little bit of market recap, talk about the different indexes, the S&P, Dow, NASDAQ, Russell. We'll get into the transports today a little bit, maybe some financials, talk and a little bit about the rates, and then the VIX. Those are the ones that I consider the main ones, kind of keep an eye on, and there's always the ancillary ones as well too. So Tony, if you have anything to add to that, we can go and look at those as well. We'll look at some broad market headlines, kind of what's going on in terms of the economic calendar, maybe some stocks to watch. Some of the sector performers, kind of see, what sectors have outperformed this week, what might continue to do so. And then, like I said, we're going to analyze it. And for analyze it, that means today we'll hop over to the options play site, and Tony can kind of walk us through maybe some of the stocks that he's watching, he and his company are watching on their end. Now, let's kick it off with a little bit of analysis right here on the S&P. And Tony, I got to tell you, it is hard to fight this market. I mean, as you can see right here, I've got a bit of a wedge or a triangle, however you want to look at it. And we broke down below it, and it looked like, especially given Sunday night when I took a look at the E-minis, the S&P 500 futures, and then especially Monday morning when I took a look and saw we were down about 80 points, I said, okay, here we go. Now they're about to crack this thing out. And all it took was a little jawboning from Fed Chairman Powell on Tuesday, and then yesterday as well. And a little bit of talk of some stimulus from the White House, and we pushed right back up, didn't we? What are your thoughts right now? Is this a bullish market? Is it a neutral market? Do we kind of need to wait and see until earnings come out, or what are your thoughts on where we're at right now?
Yeah, so first of all, as far as the broader rally that we've had since the March lows, the rally itself has actually been a fairly, what I would consider, healthy rally, meaning it wasn't like what we saw back in November to January, November to February, where it was predominantly just technology mega caps leading the charge, dragging everything higher. Markets are substantially healthier, in my opinion, because we have fairly broad leadership right now. You have small caps joining in the rally. You have equal weight and market cap weight joining in the rally. No matter how you slice and dice this data, the market, everyone's joining in on this rally. So that's healthier. And you also have a fair amount of sector rotation, which is also healthy. And if you think about it, the markets are up 35% roughly or so, a little bit more than that, depending on which index you're following. It needs to consolidate before it can continue moving higher. So I really still see what we saw on Thursday, Friday, and Monday as consolidation, right? We didn't really break below the 20-day moving average substantially by more than a few points. Certainly, it didn't close below that. So for my base case at the moment, it's still buy the dips. We're still in a bullish market. But I will say the recent sell-off has taken a bit of the momentum out of this market. So at this moment, I still think that we can continue to move higher. I'm keeping an eye out on the 20-day moving average. The 300 level or 3,000 level on SPX is the major support level we're keeping an eye out for. If we crack below that and we sustain multiple days below that, as in terms of closing below that, that's when we might start taking a look at perhaps looking at some shorting opportunities. The other thing we also look at is VIX. VIX still to this day is just 2-3 points away from moving into contango. So that's where the front month VIX is higher than the 3-month VIX. It's been just hovering right around there. So that's usually a good indicator for us that risk is off and it's time to look for some shorting opportunities. But until that happens, our base case is still buy the dips. This is looking for a continuation higher, especially if you think about the Fed continuing to buy and just the backstop that the Fed is continuing to provide for this market.
That's well said. I mean, we've talked about the Powell put now for, basically since he's been in office. And, when we did get the bounce and we held, I do find it interesting, though, that there's a couple things that I'm looking at. You mentioned the VIX is an indicator in the contango. Which I think those are great insights, and I appreciate you adding those, because that's not something that that we talk enough about. And one of the other things that I've noted as well too in the last couple weeks with some discussions for the viewers on the VIX is keep an eye on November and October VIX contracts, because those futures are staying a little bit more bid, and it makes sense, right? We're heading into potentially a very volatile time when we're talking about the elections, not only just from the executive branch, but I mean, we could see a turnover in the Senate as well, too, on the legislative side. And who knows what that could mean to, what the market, some of the backdrop that the market's rallied off of, right? Not only the stimulus that we've seen, but also some of the legislative practices that have taken some of the constraints away from some of the rallies that we've seen recently. So, that's all things to keep an eye on. Absolutely. The one thing I find interesting, though, is, even when the VIX did pull back, we really only got to pull back to right around 25 or so, and it's really continuing to hold some strength. To me, it seems like, and this is one of the reasons that I do think that there is room for that rally to continue. So, bear with me as I kind of make my way through this thought. But bottom line is, it seems like the market's long and the hedgers are long, right? So they own the shares and they're buying the protection. They don't mind rolling that protection from month to month, but they want to stay long the market and they want to stay long the protection against it. So when I see a backdrop like that, I feel like there's more room for the market to run. But I also look at it as the professionals have kind of stepped in to a certain extent. They don't necessarily trust their rally, and they're buying the protection in case that rally starts to fizzle. Do you kind of see the same thing? Is that why you see an elevated VIX at this point?
Certainly, absolutely. I will say that I think it would be a terrible job to be a professional money manager at this point, to be able to be, that you have to position long because you're going to miss out on this rally if you don't. But in the backdrop of this, I think Bank of America's recent survey of their fund managers, 78% of them, which is the highest level they've ever had since 1998, where 78% of professional fund managers believe that the markets are overvalued right now. It's never been this high historically. So it's a difficult market to position for, because again, you have this fear of missing out, right? Because you've seen this rally, it continues to move higher. It's difficult to not participate, but in the back of your mind, it's really difficult to justify continuing to go long. And that's part of why, as an option strategist, VIX is actually a very heavy influence in terms of deciding what option strategy is most suitable for this market. So when VIX is fairly elevated, we have this pickup like we saw here on Thursday and Friday. We were selling into that. We were selling put spreads to look for a small bounce. But then as VIX starts to pull back a little, if you still want to continue for long exposure, that's really where we start using debit spreads, because debit spreads allow us to take a directional view with a relatively small amount of capital at risk. So when you do have these violent pullbacks, you're not risking 10% of your account to do so, or 10% of the stock value to do so. You might only be risking 4 or 5%. You're really trying to minimize risk all around. And that's the difficult part about trading this market, is because it changes from one regime to the next within just a few days many times, right? So Thursday, Friday, Monday, that only lasted 3 days. And now we're back to potentially looking at buying options again. So you just have to be really nimble to trade these markets.
You have to sit in front of the screen is what I'm hearing. Absolutely.
I will say sitting in front of the screens is actually one of the things that I've learned to stop doing, because trading in front of the screens, you open up Monday morning, you're thinking, oh God, I got to start selling, right? Next thing you know, by afternoon, it's turned around. So, I like to actually look at my positions more once a day, and staring at the screens, I tend to find actually detract me from trading well.
I think that is some sage advice, and to be honest with you, I think that it is refreshing. Now, of course, I want you listening to Schwab Live Daily every minute of the day, of course, but at the same time, if you have the ability, get outside, get some sun, get some of that vitamin D, and avoid the restaurants, or if you're going to go to a restaurant, sit outside. There's my advice for you. All right, let's take a look at the Dow here. Dow is, pulling back a little bit today, down about 63 basis points, not a huge move. Once again, you had mentioned, I'm going to go back real quick to the S&P because I want to show this. You had mentioned that we, traded below the 20-day for about a day or two and then popped back up, and, we're holding it today. Same story here with the Dow. In the 20-day, the reason we bring that up is because it's more of a short-term indicator. And I think it's nice. It's a good way to help kind of decipher between indicators for investors versus traders. As a trader, a trader doesn't necessarily mean intraday. A trader could mean somebody that's intermediate, somebody that holds a position for a couple weeks or a couple months. I would prefer to keep an eye on a 20 or a 50-day moving average if I'm kind of in that intermediate range, looking on a 1-year chart, keeping an eye on the 20 to the 50-day moving averages. If I'm looking more as an investor and say, hey, I want to really only watch my positions, maybe once a week or every couple of weeks just to kind of see what's going on, that's where the 200-day comes into play a little bit more for me. We are a little bit below the 200-day in the Dow, but that's basically Boeing really. That's set the stage there. But the short-term trend, the intermediate trend is still bullish. You still see an upwards trajectory on the 20-day. You still see an upwards trajectory on the 50-day. You're just seeing kind of a flattening out here, a little bit of a dip, but more of a flattening out on the 200 moving day or 200-day moving average. And I think that really kind of sets it up, Tony, for a conversation around it might be a market that, I don't know, dare I say, a little bit boring for a while. Could we be in what we consider maybe a range-bound market for a little bit?
Yeah, I absolutely think that the market has found a bit of an equilibrium here. Like you don't see a lot of buying, you don't see a lot of selling pressure. Markets seem to be a little bit content, right, at the moment. And certainly, I would say looking at the COVID-19 numbers a little more closely than we did 2 weeks ago or even a month ago, to see kind of where we're heading. Also, we're starting to get into earnings season again, so that's starting to become relevant again. So I think markets are a little bit happy to pause for a minute, digest the information, and then kind of as corporate earnings come in again, as perhaps more COVID-19 numbers come in, kind of make that decision as to where we head next.
Yeah, no, that's a good point. I'm also kind of looking at the RSI as well too. It's starting to fade a bit, but this 50 line is held basically since the beginning of April when we started to pop up, and we'll see if that continues to be the case. So basically, you're seeing a rally in the market, but you're seeing a little bit less of that enthusiasm on the RSI. I think it's okay as long as we hold 50, but we'll see what that looks like going forward. If we take a look at the NASDAQ, it's a similar story, definitely a little bit more strength, though, in terms of what we've seen in technology. NASDAQ's going to have a higher RSI around 63, so 62 and change. One of the things I do point out, so when I'm looking at my notes here, is that even though we have started to kind of push back up towards the high, we've seen a push back up towards the high with a lower RSI. So we are starting to lose some steam here as we head back up. We didn't quite get back to the same highs that we saw a little over a week ago. Are starting to pull back a little bit here. It makes sense that we probably could see a retest of that 20. If that 20 holds, though, for the short term, I think that's probably a good thing. But once again, it kind of adds some credence to the idea that, maybe at least for a little bit, the highs might be in and we might be trading in a bit of a sideways pattern for a bit. Now, let's take a look at one that, has had some outperformance recently, but looks like it might be giving up some of that, and that's the Russell. So, Tony, one of the things that I was speaking with Liz Ann Saunders on Monday, one of the things that she mentioned was the outperformance in the Russell of the zombies versus the non-zombies. So basically, the companies that don't even produce enough revenue to service their debt, they're outperforming, not necessarily in the S&P, but in the Russell. So you're seeing some people start to chase some of these small cap names that had led to some of the outperformance that we had seen in the Russell versus the S&P over the last couple of weeks. And that was one of the reasons why we saw this this kind of the big push up here. But where she said, "Hey, this provides me with a little bit of a caution," is the idea that we're seeing that in the zombie companies versus the companies that have the better looking balance sheets. Is that something that that you pay attention to? Is that something that concerns you as well?
I will say that I thought I saw a snippet of that research,
Okay.
but I didn't manage to read it. But I will say that I think this is perhaps a result of the Fed buying across the board without really any consequences to what the investment grade or high yield, it doesn't matter. They're buying it across the board. And they're doing it directly in the primary markets. And I think that's part of why we saw this rally in these zombie markets.
All right. Well, let me get back in here real quick. It looks like I dropped for a second. I'm getting back in right now. Let me see if I can share this again. All right, perfect. Yep. Sorry about that, guys. Looks like we're back up. My my apology. All right, there we go. Yeah, no, Tony, I appreciate that. And as you mentioned, I mean, look, it's important to understand. I'm not saying people need to be forensic accountants and really need to understand exactly how the balance sheets work. But when you do see some of these movements, and I spent, I was talking to you earlier before we started the show about my little 10-minute diatribe on Friday about Hertz, and how I found it to be kind of a gross misappropriation in terms of how do you go ahead and try to gather more funds? Well, you do that by trying to issue more shares in the secondary market while you're going through bankruptcy proceedings. Well, sure enough, this week that came to a grinding halt. And I'm not saying that all the companies that you're going to see on kind of that zombie list fit within that same criteria, but these are basically companies that, as I mentioned, they're not providing enough revenue to service their debt. So just be careful, people, when you're starting to go through and you're starting to see some of these moves on some of these underperforming names, and underperforming not necessarily in terms of what the stock's doing, but underperforming in terms of what they're doing on a profit and a revenue perspective. And that's one thing that provides me a little bit of caution, Tony, when I see some of the moves in some of the transportation names, especially. We can take a look at one of the stocks in the news today is Carnival Cruise, but I'm going to bring up the Dow Jones Transportation because I think it's important to kind of keep an eye on this as well too. It's had a nice little bounce off the bottom, 6,500, traded up to 10,000. So basically a 50% move off the bottom. And here we are pulling back a little bit. I just wonder how much of that momentum can hold. And I also wonder, as we kind of go through some of the questions that we've seen along the way, some of them are around the financials too. As you look at some of the financial names out there, let's just take a look at the XLF. Are you concerned that the financial sector is not going to be able to kind of hold some of these gains off the bottom, or is this something where you're saying it looks like maybe rates might start to be kind of steadying out a little bit, and as we're kind of forecasting forward, maybe the financials can have some outperformance here?
So I completely agree on both fronts. Number one, I actually think the transports is one of the sectors that I think went a little too far too fast. That was actually the part of our research from last week. We saw that sell off, especially the airlines, right? The airlines, the cruise stocks, those stocks, in my opinion, went a little too far too fast. We're seeing that pullback. And I think we're starting to come back to reality on some of these things. Financials, similar thing, right? Financials had that huge rally off of rates moving higher. And as far as why rates moved higher, it was a bit of a fluke here, right? You had 10-year yields jump from 70 basis points to 90 basis points within a few days, and then came quickly crashing down. And that's exactly what we saw in financials. So that also was one of those rallies that we thought was pretty suspect. So at this point, especially if we look at the weaker names within the banks, like if you think and look at Wells Fargo, even JPM is looking from a chart perspective pretty weak here. These are the types of names that I think is going to have some trouble rallying with the market here. Surprisingly, JPM, we usually think of this as best of breed within the financial space, has been lagging substantially. Surprisingly, Goldman Sachs and Morgan Stanley have been doing substantially better.
Well, and one of the things that you mentioned heading into earnings season, those are the first to announce, right? So we'll find that out basically day one or day two of earnings season, how some of the banks have performed this last quarter, with the change in rates and what we've seen. And we talked about this before, the idea that there was a little bit of underperformance last time in the earnings, and part of that was because they were holding extra assets on the balance sheet for the potential for underperforming loans. We'll see whether or not they, when they report in July, whether or not they freed up some of those funds, because one of the things that we've been addressing on closing remarks and on some of the other shows that we do here at on Schwab Live Daily is this idea of what's the difference between the money supply and the velocity of the money supply, right? So we know there's a ton of money out there, right? We know that the Fed is basically printing money and providing that backdrop, but is that money making its way through the economy? And we've shown some disparities there between the two, that even though there's money out there, it's not necessarily getting all the way down back through the economy. And part of that, Tony, is just logistically it makes sense, right? Everybody's been kind of on lockdown; they haven't been able to go out. But the other issue is as well is that the banks aren't necessarily loaning it out to to the clip that I think people were hoping that they were. So we'll get a little bit more information about that in the next couple of weeks as those earnings start to come out as well too. All right, let's do this. Let's go. I want to go really quickly to talk about the economic calendar today because I found it pretty interesting. What I found interesting today, starting off, was with the jobless claim. So, they came in a little bit higher than was expected. So the weekly initial jobless claims came in at 1,508,000 for the week. So the trend is moving in the right direction, right? But that was a bit above the estimate of 1.29. And that did compare a little bit favorably to last week's 1.56. So it came in a little bit, but the 4-week moving average is falling. That's what we want to see. We want to see, just like we talk about moving averages on stocks, you can look at a moving average on some of these economic indicators as well too. 4-week moving average has come down to about 1.77. Continuing claims, they declined by 62,000 to 20,544,000. That was a little bit above the estimates, or about 600,000 above the estimates, or 700,000, excuse me. 4-week moving average continuing claims dropped by about 1.1 million to 20.8 million. So that was a bit on the bearish side in terms of some of the economic news, but on the bullish side, and you do have to take some of these regional manufacturing numbers with a grain of salt, right? Because they are regional. But this one is interesting. The Philly Fed Manufacturing Index in June, it came in expansion territory. So I don't think anyone was forecasting that. Basically, anything above zero, it jumped to 27.5 from the negative 43.1 it posted in the prior month, and that was versus expectations of a minus 21.4. So, those are all numbers. But what was interesting, and here's what I found interesting, is one of the things that we haven't talked about really, I want to say since October, November, is an increase in new orders and shipments, because even as the economy was potentially kind of, I don't know if you want to say humming along, Tony, but that was one of the things that we had been keeping an eye on, was the new orders on the manufacturing side had been slipping. Really, it had been slipping in the fall and the early winter. And, we got to a point where it was so depressed in April, we really did see some of the worst reads we've ever seen in history. But now new orders and shipments, they did lead that charge back to growth. And so that was interesting to kind of see there from the Philly Fed side. And then the last thing I wanted to point out real quick, and I'll get your thoughts on this, is the index of leading economic indicators. That this is something that I tend to look at quite a bit. It actually rose 2.8% month over month. There was a projection of it to rise 2.4%, so it did come in a little bit more bullish than expectations. Now, granted, you're starting from a low base, right? So you do want to keep an eye on that. But we did rebound from April, which revised a 6.1% drop, and March 7.5% drop. So those are the biggest monthly declines on record. And to see a nice little uptick in the LEI, that's good. But here's where I wanted to point out the bullet points on this one. The positive contributors, they came from less elevated jobless claims. So I guess there's a proper spin on that one, right? So there weren't as many jobless claims as were expected. The average work week went up, and building permits and stock prices went up. And we saw, as you mentioned earlier, stock prices rallied about 35% off the bottom. But in contrast to what we saw with the Philly Fed, it was the ISM new orders that came in negative, and they did weigh noticeably on the index. Are we at a point now, Tony, where we kind of just need to take a break from looking at some of the fundamental data and just say, we know that the Fed's got a bit of a backstop in for the market, watch the technicals, and just kind of trade off that? Are we at that point now?
I absolutely think that we've been in that space for quite a few months now. And, looking at all of these economic numbers, as you first said, you have to really take a lot of these numbers with a grain of salt. There's, especially with these economic numbers, especially with jobless claims, with unemployment numbers, there's a large variance in terms of for errors at the moment. So right now, the numbers themselves don't mean as much, more so than just the trend itself. We're just really looking at the trend. Is it improving? Is it deteriorating? That's really what we're looking at. The actual number itself, I think, is they're just so large, and so they're almost meaningless to some degree And there's quite a bit of error again right now in some of these numbers. So we expect to have those revisions in the coming weeks, coming months, but we're not going to know that until, perhaps in August or even September for some of these numbers. So from my perspective, the focus right now is it trending, higher, and that's really what the market is trading on, right? The market, when we see it, the unemployment number came out a couple of Fridays ago. Whereas 13.3%, and they were estimating about 19%, and we rallied significantly higher. Did the rally match the number? I don't necessarily think so. I think the rally just matched the fact that we were getting better, and I think that's the important thing to look at from the economic numbers perspective right now.
Fair enough. All right, let's take a look at a couple stocks in the news, and then we'll hop on over to your site. So we start off with Carnival. We mentioned that a little bit earlier. Big rally off the bottom. It's one of the more highly traded stocks out there in terms of volume right now. It's clearly a speculative play, and look, that's not my perspective on whether it's a good stock. I'm just saying in terms of the amount of new traders involved into it. Yeah, you have to imagine it's more of a speculative trade right now as opposed to people positioning for longer term gains. But Carnival came in. The operator reported a preliminary quarterly loss of $3.30 per share, wider than the anticipated loss of $1.56. So they basically doubled. The preliminary revenue figure is also below the current consensus, and they said they expect a net loss for the second half of the year. But on the positive side, they are seeing more growing demand for 2021 bookings. Tony, will you be taking a cruise in 2021?
I will not be. Well, I don't know that I would have taken a cruise even if it wasn't for COVID-19. So,
you're not a fair assessor of that one. I will not be taking a cruise either in 2021. We have that in common. Now, looking at Ford. Ford is basically unshot on the day. Once again, it was one of those stocks that if you look at volume, it's been a bit of a speculator's delight when you kind of see some of the moves it's had. I mean, it's basically doubled its value off the bottom, got almost all the way back up to $8 before pulling back when it failed at the 200-day moving average. But Ford said today that they will offer hands-free driving in their new Mustang Mach-E model. That is the electric crossover that'll go on sale later this year with the active driver assist software. Unfortunately won't be available until the fall of 2021. So Tony, when you buy the Mach-E, if you want to, just kind of sit back and read your paper while the car is driving, unfortunately you got to wait about a year and a half on that one. So my apologies there. All right. Similarly, Tesla, once they've had their active driver assist technology out for quite a while now, Jefferies raised their price target on the automobile to a street high $1,200 a share. I mean, I'll just stop there. From the prior $650 a share, saying that the gap with competitors is widening both in terms of product and battery technology. I mean, it's a monster. It's a monster that continues to press new highs. Even on days when they try to push it down, it bounces. RSI looks strong. I mean, it's kind of hard to say anything negative about this stock except that it's a valuation, and this is one of those ones where until you see more competitors step in the space that have better technology and have better cars, and now with Chinese demand kind of ticking back up a little bit, the stock might have some more room to run. It's just kind of hard to get in front of this one, isn't it?
Yeah, I mean, I think the way to think about this is you can't think of Tesla as a car company, especially not from a valuation perspective. You have to think about this as a battery company that happens to make cars right now, and they're going to make trucks next. They're going to completely revolutionize trucking industry, because if you think about all the transport of goods that are moved around, 70% of it is moved by trucks around the world, right? Not by airplanes, not by cargo, or ships rather. It's mostly moved by trucks. And if he's building a company that's going to completely change that industry, and you think about the fact that that the whole nation is wired based on this grid system that isn't very efficient, that it's not easy to move electricity from one part of the country to the next, and that you're going to have solar power and you need to store that solar power somewhere, and you think about Tesla as a battery company, then the valuation doesn't become so crazy. And if you're investing it for the long term, there is a case, in my opinion, that could be made for $1,000, for Tesla and potentially higher.
It's pretty incredible because, as you mentioned, and I'm glad you did break it apart that way, because I think too often people say, well, let's look at this versus GM or Ford, and you can't make those comparisons because their growth isn't necessarily in the automobile sector. Their growth is in all of the other ancillary products that's provided. Remember, when you buy, you do get a share of SpaceX too in there to a certain extent. So, there's a lot of different products that are coming out of this company that, as you mentioned, you just can't value it off a normal fundamental analysis, so to speak, with this one. So that's interesting. And then last but not least, let's get into what we talked about this a couple minutes ago, Hertz. Hertz, interestingly enough, I would have thought it'd be further down than this, but it's holding strong. It's another one of those stocks that when you look on those speculators list, it's usually one of the top 10 or 20 stocks. So only down 8.5%, 17 cents. We did trade up to, I think, a high last week of around $6. So definitely, quite a bit lower from there, but way off the bottom of 40 cents. So, that's a trader stock, in my opinion, until your hand gets caught in the cookie jar. I guess you can do what you want with that one. The reason I say that, Tony, is because one of the comments I got last week when we were talking about this is, hey, Joe, this isn't really helpful for you to say that when we're able to scalp it back and forth. And I guess my response to that was, if you can make your dime scalping this back and forth, more power to you. But at some point, that merry-go-round is going to stop. At some point, you're going to be reaching for that last chair. And I just want to make sure that you guys are aware of the risks that are involved in participating in a company, or at least trading a stock like this along the way. So there you go. All right, Tony, do you mind if we hop on over to Options Play site real quick?
No, not at all. Let's take a look.
All right, so let's do this. Why don't you explain the site a little bit to us, and then you can kind of give us maybe some of the symbols that you want to take a look at here.
Yeah, so first of all, this is a tool that everyone can access directly through Schwab, through Street Smart Edge. We also have a free 45-day trial for everyone to take a look at, as well as a discount if you do choose to subscribe after the first 45 days. But the platform itself is devised from the ground up to revolutionize the way that you look at options trading. And we built this because we looked at the user experience of looking at an options chain. Now, when you know what you're doing and you know what you're looking for, an options chain is very easy to navigate. I shouldn't say easy to navigate. It's quick to navigate to get to exactly what you're looking for. But if you're in the process of exploring, if you're in the process of learning, and you're trying to get an idea as far as where should you start, we wanted to build a user experience that made it a little easier for you to understand. So the tool itself is divided into 3 sections. You have trade ideas and watch lists on the left-hand side of your screen. The middle panel is your security analysis panel. And on the right-hand side is trading and income. So we call these 3 panels the what, the why, and the how of options trading. So what symbols do you want to pay attention to, whether you're looking for fresh ideas or you're looking to build a watch list so that you can keep track of the ideas that you're looking for. The middle panel is really designed to give you summary technical analysis data. Now, I've been working as a market strategist for the last 13 years, and I started in Forex, in currency trading. And for those of you that trade currencies, you know that there's a lot of technical analysis involved in that. And as part of that process, I've worked with clients with hundreds of indicators on their charts. There was just cluttered with indicators, RSI, momentum, moving averages. And there were so many indicators, they couldn't even see the chart itself. And I see so many cases of that. So what we wanted to do was to simplify technical analysis for you. Instead of drawing the indicators on your chart, we interpreted the moving averages for you. And that's why you have a 1 month and 6 month trend at the top of your screen that doesn't clutter your chart. So you just see the moving average outputs as a result of that. And the benefit of that really is, one one of the other challenges that I've noticed with moving averages is sometimes we use the 20-day today, next day we use the 50-day, or maybe if the 50-day doesn't agree with our analysis, we go back to using the 200-day. We keep trying to find a moving average that justifies our directional bias. So by removing that, you remove some of that bias for you, right? So it's always the same objective view to looking at the moving averages. And then we use technical score, which is our relative strength indicator. We think relative strength and trend are two very important components of technical analysis to give you a strong directional view. So if we're looking at Salesforce here, 1 month and 6 month trend is bullish. It actually just turned both bullish just a few days ago. As you can see, the 1 month indicator was neutral for a few days and recently just turned bullish. So we know that the bullish trend recently just started. It's got a very strong technical score, meaning it's outperforming 90% of the other stocks in the market. That's why it has a score of 9. And then you have things like earnings, dividend data, and price action data below to give you the data that you need in order to really trade options. These are the things that we found on multiple screens. We wanted to give it to you all on one screen. And then the third piece on the right is trading and income. This is really designed to give you a starting point, regardless of what your views are, whether you are bullish on the stock, bearish on the stock, or if you're looking to generate income. We give you starting points, not only the strategy, the expiration date, but also the strike price. So if we look at CRM real quick, right? And I haven't looked at CRM for a few days now, but the fact that you brought this up, the stock looks like it's just, breaking out here, breaking out to a new all-time high here. And let's say we're bullish on CRM, right? We think it's going to continue moving higher. So if you can select I'm bullish here at the bottom, which we already have, we automatically default to 3 bullish strategies that you can take on CRM. You can buy the stock, which is a simple stock strategy. You can buy a call option, which is a simple option strategy, or you can buy a call spread or a vertical spread. And for those of you that say, I don't know what a vertical spread is, that's okay. We're here to help you learn and explore without you having to look at an options chain in order to figure out what you're looking at. So the 3 strategies are presented to you side by side. And then we have a P&L simulator at the bottom that allows you to simulate how these strategies are going to work. So, I always tell users, if you're thinking about a strategy, first think about the risk, right? Forget the upside for 1 second. Think about how much are you risking, because that's really the one thing that you truly have control over. And if you can minimize your risk, that's the only way you can maximize your upside. So what we're going to do here is we're going to use our P&L simulator. Now, Salesforce closed at 187 today. Let's say this breakout fizzles out, right? And the stock goes back to that 165 support level. So Joe, if you don't mind, drag the P&L simulator target price back to 165, right? Let's just say, what if we're looking for this breakout, it doesn't happen, it fizzles out, and the stock settles back around 165. If I had bought 100 shares of the stock, I'm looking at roughly a $2,200 loss here on my $18,000 investment. If I bought the call option, I'm looking at about $198 in losses. So a fraction of the loss, almost 1/3 of the loss that I would have if I had bought the stock. And that's really the benefit of buying a call option, right? Is because you can take advantage of unlimited upside, but you have limited losses on the downside. And then further on the right-hand side, that third strategy, I'm only risking $805 because it further reduces my loss. So whenever we're trading options, my goal always is how can I reduce the risk of my strategy? Because when I'm able to reduce my risk, what that's going to do is going to amplify my returns if I am correct on that directional view. So now let's say Salesforce does break out to all-time highs. The 52-week high is around 195. If we're looking at CRM real quick, let me just pull up a chart here. 195 is the all-time high. Let's say we think that on this thing can break back above that 195, maybe hit that 200 mark. So let's try for 200 to the upside, which is only $15 to the upside, right? On a stock like Salesforce, that's not that big of a move. It moved from 170 to 185 in the past few days. So if you do get a move up to 200, if I bought the stock, I'm looking at about a 6% return. If I bought the call option, I'm looking at about a 26% return. And notice here that strategy on the right-hand side, even if you're not as familiar with that call vertical yet, then you're just in the process of learning how to trade options, you can see that not only did I reduce my risk to the downside if I'm wrong, But if I'm right and the stock does rally, I'm looking at about almost double the return of just buying a call option. And this is really where you start to learn more about options trading, and it really allows you to compare strategies side by side. And that's really one of the most important things about options trading, is that there are so many options. You need to be able to compare them side by side. You don't want to just randomly pick a call and hope you're making the right investment decision. Put different calls side by side, and this tool allows you to modify any of the strategies. So if you want to change the expiration date, the strike price, you can go ahead and do that and use the P&L simulator and truly understand the potential risk and potential rewards of each trade before you get into a trade. So that's just a very quick brief overview of this tool. And if we want to take a look at a symbol, a symbol that I've been paying attention to in the realm of what we were just talking about is CarMax. So if we're talking about cars, if we look at it's KMX.
Okay, Max, sorry.
If we talk about GM and Tesla, especially post COVID-19, I think number one, people are more likely going to be driving rather than going on public transport. One of the reasons why I like companies like Lyft, I think it's going to be the type of company that might do well post COVID-19. But CarMax, and given the economic backdrop, given the high amount of unemployment, I think it's less likely that someone is going to go out there and buy a new car, and more likely that they're going to go out and buy a used car. And CarMax is the largest car dealer in the United States. So this is one of the reasons why I quite like this particular name. Now, I will say the options here are quite expensive here. So, but this is one of the names that I wanted to take a look at, but perhaps there aren't any great options for us to take a look at here at the moment.
Well, one of the reasons, Tony, the options are expensive is because the earnings, right? Earnings are coming out tomorrow morning. So that's, that would explain that.
Exactly. So as you can see at the bottom here, June 19th is the next earnings, which is tomorrow morning. So let's look at another name. Let's look at Microsoft. This is another name that I quite like, as we shift our, how we work going forward post COVID-19. I think Microsoft is certainly going to be one of the stocks that is likely going to benefit from that. So let's say if I wanted to buy 100 shares of Microsoft, this would cost me $19,000. If I bought a call option here, it would cost me $950. Now, we always like to think of the amount that we're paying for a call as a percentage of the stock price. So if I'm paying $9.50 per share for a stock that's currently trading at $195, that's only about a little under 5% of the underlying stock price. That means no matter what happens, even if Microsoft goes to zero, I'm only risking 5% of the underlying stock price to make this bullish bet that Microsoft continues moving higher. And that's the benefit of options. But if you see the strategy on the right-hand side, the call vertical, what I'm doing here is I'm still buying that same 195 call, but I'm selling a 217.5 call against it, meaning I think Microsoft's going to go higher, but there's a limit as far as how far I think Microsoft can go between now and July 31st, which is the expiration date we're looking at. And what I'm doing is I'm basically selling off any upside above 217.5. Sorry, Joe, were you going to say something?
No, I was just going to add to that. One of the things I think is really helpful, Tony, about this is the visuals that you have here. And I go back to when I first learned this business, I want to say I'm dating myself here, about 21 years ago when I first got down to Chicago. And one of the things that, my bosses had me do at that time was literally draw these risk graphs, right? And so and for me, learning, that this is where I can't lose any more money, right? Because it levels off here. That means that that's a debit. I'm paying a debit for that. So, my risk is the debit that I paid. And I know that's defined right from the beginning, but since this does not cap off, that means that there's unlimited potential to the upside. Whereas here, the same idea takes hold. We have a defined risk to the downside, but now we actually have defined profit to the upside, to where at some point it does cap off. However, the trade-off between these two strategies is, by buying the call alone, as you had mentioned, the 195 calls, you're paying $9.50 or $950 in terms of real money to do that. Now you're taking $1.80 or $180 of that potential debit risk off the table, but you're doing so with the idea that you're willing to forego some of that upside. So that's when I see this, my eyes automatically go to this, because I can, I can identify from the risk graphs, and I think that's a really good teaching opportunity, for the viewers to see something like that.
Yeah, and And the goal here really is that by reducing my risk from $9.50 a share down to $7.70 a share, instead of risking 5% of the underlying stock price, now I'm only risking 4% on the underlying stock price. So I've reduced my risk by 20%. And when you're able to reduce your risk by 20%, it really magnifies your potential returns. As you can see here, if Microsoft rallies higher to even let's say 210, right? Even if this stock rallies just 210, which is $15 higher, notice the difference between just buying the call option at 950 versus the call spread at 770. That 20% reduction in risk accounts for almost doubling in terms of the potential return here. A 57% return if I bought the call option, which is certainly not a bad return to look at, but that call spread, even though not only have I reduced my risk, I've also amplified my return. So that's the only way you can amplify returns, is really by reducing risk. And that's why the strategy on the right is a strategy that we always teach for you to strive for as you're learning options, to really understand the benefit of options and kind of use this as inspiration as to all the different things you can utilize options for. So I know my time is up, but this gives you a quick understanding as to how to utilize options play to seek opportunities and explore the different option strategies you could deploy in your portfolio.
Well, that was very well said, Tony, and I appreciate that. And I do want to point out a couple questions that we had come in here. One was pointing out that options play, you can access it from Street Smart Edge under, if we go back to here, if we go under the Find Active Tools or Launch Tools, this is where you can find some of this in the traders marketplace. So there's options play right there. They're third party, so our affiliation with options play is not company to company, but just the ability for Tony to come on here and talk to us on Schwab Live Daily and closing remarks. That's our affiliation. Tony is not affiliated with Schwab itself. A couple other questions that came up along the lines of futures next. So we do immediately following us, or in about 10 minutes, I guess is probably a better way to put it. We have Introduction to Futures. That will be with Craig Borzinski and Joe Schulte. Make sure you stay tuned to that. Some of the strategies that we talked about today, whether it was buying calls, whether it was a call vertical, go ahead and take a look at our options calendar. So you can access that right there on the site where you guys are looking right now. Take a look at all the different options content that we have. I know, Tony's you normally stop by at least 2 or 3 times a month to help us out. So maybe bookmark those. You can add all of those to your calendar to get reminders to check us out on any of the options content that we have, or anytime that Tony's on here as well. To add that to your calendar as well. Another question came along the lines of said, do you need anything specific to access the futures webcast next? No, you just need to stick around. That's all you need to do. You even have plenty of time to go grab yourself a nice cold, we'll just say a nice cold frosty beverage. How about that? We'll leave it at that. Go grab yourself a little snack now that the trading day is winding down for our last 10 minutes. Tony, I want to say thank you to you as always, sir. It's always a pleasure having you on. Thank you so much.
Thank you so much for having me. Thank you so much, everyone, for joining this afternoon.
Absolutely. I want to say thanks to all of you again. And as I mentioned before, stick around. In 10 minutes, we have Introduction to Futures. I'll be back tomorrow. If you can give me another day, you want to listen to me for one more day, I'll be back tomorrow doing closing remarks, same time, same place. Everybody have a wonderful afternoon. We'll see you. Bye-bye.
Hello and welcome to the Quick Start video for layouts in Schwab's Street Smart Edge platform. Layouts in Street Smart Edge are different views you can create to help organize your workspace. They are conveniently displayed in tabbed format with up to 8 layouts able to be open at one time. For example, rather than trying to fit all the research tools you use plus trading and account information on one screen, you can create one research layout and one trading layout and flip between the two. The possibilities for organizing your work area in Street Smart Edge are extensive and designed to meet the needs of a variety of trading styles. With Street Smart Edge, you can create your own layout or choose from our predefined layouts. One predefined layout is the account layout. This layout provides tools to help traders monitor their accounts and includes 2 account details tools showing order status and balances, a My Positions watch list, Symbol Hub, and messages. Another predefined layout is the Screener Research layout. Designed for seeking and analyzing potential trade opportunities, this layout includes the following tools: Screener Plus, News, Research, and Notes. The last predefined layout is the Trade layout. Designed to help make the trading process efficient, this layout includes the all-in-one trade ticket, news, chart, watch list, account details, and messages. Once your layout is the size that you want, add tools from the Launch Tools menu. Remove tools by clicking the X in the upper right corner of the tool. Expand or contract the size of a tool by moving your mouse over the edge or corner of the tool until you get a double arrow. Then click and drag until it's the size you want. You can move tools by clicking in the title bar of the tool and dragging it to another spot in the layout. Edges of the tools are magnetic and will snap together when they are placed close to another tool. What about linking? With Street Smart Edge's tool link icons, when a security is changed or loaded into one tool, all other tools with the same link icon will automatically update to reflect the symbol change. Here's a tip for those of you that use multiple monitors. You can undock layout tabs from the primary window by clicking on a tab and dragging it outside of the primary window area. Let's talk about saving layouts. Whether you started a layout from scratch or you tweaked an existing predefined layout, you may rename the layout and save to either the local computer or to Schwab's server. Remember, up to 8 layouts can be saved to the Schwab servers. This concludes the Quick Start Guide for layouts for Street Smart Edge. Please check out the Learning Center and the online help manual, both of which are located under the Help menu. Additionally, you can visit the calendar on schwab.com/live for a schedule of upcoming live platform videos. Thank you for choosing Charles Schwab and have a great day.
Average true range, or ATR, is a technical indicator that can tell you how volatile a stock has been on average over a specified period. ATR is particularly useful for setting exit levels as part of your risk management strategy. It can also give you a sense of how strong price moves are, which is helpful if you're trying to identify the start of a trend. In short, ATR takes a holistic look at a stock's price moves over a set period and smooths them out into a single number expressed as a dollar amount. ATR is based on the concept of true range, which is basically a way of measuring a stock's daily trading range that accounts for gap openings, which are when a stock opens sharply higher or lower relative to the previous day's closing price. Why is it important to account for gaps? Here's an example. Imagine 2 stocks that both close at $50 a share. Overnight, stock A gaps higher and opens at $60 a share, while stock B opens close to its $50 close the day before. Stock A then goes on to trade within a range of $3 between its daily high and low, while stock B trades with a wider range of $5. Traders who only look at the stock's daily trading range might say that stock B is more volatile because it experienced wider price swings that day. But this fails to take into account stock A's $10 gap up overnight. True range allows for gap openings like this by comparing the day's highs and lows with the previous day's levels, giving you a better sense of how much the stock's price has actually moved over time. Averaging out a stock's daily true range values over a defined period gives you its ATR. The default period on many trading platforms is 14 days. Some traders also use 20 or 22 days, as there are generally between 20 and 22 trading days in a month. Before getting into how to use ATR, there are a few things to note. First is that ATR is based on absolute price changes, not percentage changes. Accordingly, higher price stocks typically have higher ATR values than lower price stocks. After all, a $10 move in a $100 stock is less significant than a $10 move in a $20 stock. Second, changing ATR values indicate changes in volatility. If a stock's ATR is rising, it means volatility is increased over the period, either because of a sharp rise or a sharp fall. ATR doesn't tell you which direction a stock has been moving, just that it has been moving. If the ATR is shrinking, it means the stock has been less volatile over the period. So how do traders use average true range? Some traders use ATR to help them set stop-loss levels. Say a trader sees a stock trading near a support level and the stock has a 20-day ATR of $2.25. They may place a stop-loss order a bit more than $2.25 below support so that a one-day move through the support might not trigger the order. Remember, too, that there is no guarantee an order will be executed at or near your stop price. Traders can also use a strategy sometimes called a chandelier exit, which uses ATR to set trailing stops and is designed to help traders ride a trend while managing the risk of an early exit in the event of a temporary reversal. A common approach is to set a trailing stop 3 22-day ATRs below each new high in an uptrending stock or over each new low in a downtrending one. With a trailing stop, the stop price can tick up or down to account for changes in the stock's price. Then, if the stock changes direction, the stop price will freeze at its new level, and if the stock then hits the new stop price, it becomes a market order. So, if a stock has an ATR of $2, then you would set your trailing stop $6 above or below the current market price. The idea is to have a buffer that is 3 times the current volatility of the stock. As a result, when volatility, as measured by ATR, is high, you have a larger buffer which can give a stock more room to swing. So be sure you're comfortable with that. When it is low, your buffer is smaller. Of course, whether 3 ATRs works for you will depend on your risk tolerance. If you're trading an uptrend, you might consider selling a long position if the stock's price falls below your chandelier exit. Similarly, if you're trading a downtrend, you might consider buying back the short position if the stock rises above your exit. Finally, many traders may use ATR to gauge the enthusiasm behind a stock move. Strong moves, either up or down, are often accompanied by expanding ATR values. This is especially true at the beginning of a trend. For example, a break of support or resistance with an increase in ATR tends to validate the move. To learn more about technical indicators and how to use them, watch the other videos in this series and subscribe to our YouTube channel.
Live from Schwab Studios, this is Schwab Live Daily.
Good afternoon, ladies and gentlemen, and thank you for tuning in for our last segment of Schwab Live Daily. We're set for an introduction to futures trading segment. Very excited to present futures trading to you. And joining me today from Denver is Craig Porozinski, one of my colleagues. Craig's got a background in the financial futures, which will be a great mind for us to tap as we're going through our discussions today. Craig, how are things going today out in Denver?
Things are great. Thanks for having me, and the check is in the mail for the nice, kind words there, Joe. Thank you.
Very welcome, very welcome. Well, we're looking forward to tapping you on some of our discussion today, Craig. But before we do, as always, we have to touch on our disclaimers here, some important information for our listeners. Futures trading offered and positions held through Schwab Futures Incorporated, separate but affiliated company of Charles Schwab. Both are subsidiaries of the Charles Schwab Corporation. And most importantly, futures trading involves substantial risk and may not be suitable for all investors. Please read the disclosure statement for futures and options. And on top of that, keep in mind any examples, scenarios, what-if type conversations that Craig and I bring up today are simply that. They are discussions. They are not meant to be taken as any form of advice or trading suggestions. So let's dive in today and see what we're going to be talking about. So we've got a bit of a format here. It is a very loose format. I would like to encourage all of our listeners to certainly send in questions. You can type them in at the bottom of the screen, and Craig and I will do our best to answer your questions. Having said that, we will try to follow a bit of a format here, going over some of the basic fundamentals of futures trading. You know, what is the definition of a futures contract? We'll go into contract specifications, talk about expiration months, settlement procedures. Symbols is another big one that may be foreign to many of our new futures listeners. And then we'll get into discussions about tick, leverage, and margin, another big discussion. Anybody that has already been enabled for futures, or anybody that has asked about it and had their StreetSmart Central platform enabled, I would encourage you to open up your StreetSmart Central platform for today's discussion. I think you'll find it handy to kind of drive yourself as we're talking about certain subject matter. When we reference StreetSmart Central, I think you'll find it very useful for yourselves to do the same and kind of become comfortable with the platform. StreetSmart Central is the platform you will need to trade futures at Charles Schwab. That's in addition to the normal Schwab.com platform and the flagship StreetSmart Edge platform. On both of those platforms, you can access StreetSmart Central directly, okay? In Schwab.com, it's in the upper right, very upper right corner under the trading hub. Sometimes you'll see two arrows. Click that, follow the links to StreetSmart Central. And in StreetSmart Edge, if you go to your tab for trading tools, it is the second one, top column, far right. It says StreetSmart Edge. That'll take you directly there. Once you're logged into StreetSmart Edge or Schwab.com and go to the link for StreetSmart Central, there's no need to log in